The S&P 500 continues to tease us at this important resistance level right now, ahead of a lot of economic data that came out today and a lot of earnings that are going to be coming out here this week and going forward from here. So we have a busy calendar, a lot to talk about from a technical perspective. Are we going to be able to get through this resistance? Are we going to pull back first? I'm going to break down the technicals to see what we should expect. And then with today's trade idea, we talk about how to take advantage of earnings that's coming out this week. So let's go ahead and get started. Today is Monday, April the 16th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching us tonight. Welcome to those of you that are watching us for the very first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking on the Market Scholars logo in the bottom right corner of the video. Also hit the thumbs up icon that's down below the video. That lets me know two things. Number one, it tells me you like the video, you got something out of it. It tells me, number two, that you want me to do the video again tomorrow. So one click, really easy way to give us feedback. Comment on anything that stood out to you from today's video. Scroll down further below to see the comment section down there. Join our daily Market Outlook email list. You'll see a link down in the video description to be able to do that. Follow me on Twitter for more content in addition to these videos. You see my handle on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. Always pinned to the top of my timeline. Finally, join the almost 1,000 people that are in our Market Outlook community on Facebook. The address on the screen at the top. There's also a link in the video description that will take you there as well. All right, let's take a look at the S&P 500 then with the market forecast indicator. The posture remains bullish. You notice we're still at, multiple layers of resistance in this area here. Smidgen up above 267.50, which is that important level, or 2675 on SPX. So we're in that area of resistance and unable really to battle through that so far today. The intermediate line continues to rise. Good sign. Bullish posture there. Not strongly bullish yet. Not really very strong yet. Still weak bullish posture because we're below 50. It's got to get in the upper half of the chart before you start to anticipate that 1 to 3 month time frame. Market sentiment's bottoming out as the index itself is attempting a major low point, forming a major base for a potential low point here. Near-term line stayed in the upper half of the chart, which means now we've got 1, 2, 3, 4, 5 days. 7 to 12 is the norm when we are bullish. But part of that, there has to be some of those days within that 7 to 12 day window where the blue line gets above 80, and we don't have that yet. So another sign that we're not as strongly bullish as we want to be yet. And there's a lot of reasons. I mean, we still are stuck below this resistance and not quite able to battle through. If you take a look at the Dow Jones Industrial Average, you'll see a very similar picture here. Pop that up here for a second. You'll see it's same thing. Its intermediate line's close to crossing above 50, but you see how we're still, not able really to close above these highs. The near-term line's not able to get above 80. So, yeah, there is a bullish bias to what we're doing, but not we don't have that breakout move yet, as you'll see with other charts here in just a minute. Near-term line again here popping down with that divergence, so clear divergence here, setting up a bearish divergence. Doesn't have to mean we have to go all the way down here. I mean, that's where the low point would be. That's where your first target would be based on that divergence. But this kind of shows, again, just how weak. I mean, this is even got a weaker bullish posture than those large cap indexes do because it had a bigger pullback than the large cap indexes did. But you notice, see this low point in between, that we're hitting our head up against that area, 7,200 in this case. We're hitting our head up against that area in all these major indexes, except for the Russell 2000, which is more bullish. You can see it's way up above that low point. It's been more bullish. It's the only one that has the intermediate line up above 50. The near-term line did get above 80 during this rally. We do have the 5 days, 1, 2, 3, 4, 5 days up above 50, so a good sign there. Momentum line did pop down yesterday, but not too extreme, so no concern, or Friday, excuse me, no concern with the posture change there. Didn't quite get above the highs of the past couple of days, but we are above the moving average. We are above the 50% retracement. I mean, there's all these things that we are hitting our head up against on these large cap indexes. We're not on the small caps. Now, it's not taken off yet because the others aren't able to take off yet either. But you see how there is a bullish bias. We are leaning to the bullish side, even if we're not necessarily back up the truck and loaded up bullish quite yet. So go back to the S&P 500. Remember, the market sentiment line is at a low point that can launch more of an extended run. So when the intermediate line does run up above 50, our expectations now could be more towards the 3-month end of things, the 2 to 3 month end, instead of the 1 to 2 month end, because of how low it is. Now, that doesn't guarantee that will happen, but it's just what it's telling us is it is low enough now that it's below 50 that we can get a bigger run out of this. We've had enough of a pullback, and all it did, this orange line, is the 38% Fibonacci retracement of the previous run off of a market sentiment low that got below 50. So we had a run. It was more than a year's worth. We had a normal pullback, even though it doesn't seem very normal. In context of that big bullish move from the election to now, or to January, this is a very normal pullback. It just looks abnormal and seems abnormal, seems very volatile because of how big that move was and how low volatility was for most of 2017. All right, before we look at some of these other charts, I just want to remind you again, if you're watching this video embedded in our blog, in the Market Scholars blog, remember you can click on the link right above to discuss this video. As you see, we've been getting a lot of great discussions in the market outlook and the different classes that we have on the calendar. And don't forget that we also have the promotion here for gift cards for the most engagements in the forums, and so you are all able to participate in that promotion again by clicking in the Market Outlook forum. And two, remember to like the Market Outlook tweet and Facebook post down here. The more that you like it on the blog, or like it on Facebook, or like it on Twitter, then that's what tells us that you like the video, that you want us to keep doing it day after day. So now we got the green arrow on that 50-day moving average again, so we're back up above it. You notice we're still not quite able to close above these highs. 2680 is the high from last week, so we're at 2677. So not quite there, but at least back up above. And again, that 50-day moving average acting as a resistance area here. Then you take a look at the 3 green arrow chart, and like I said, 30-day moving average, Fibonacci retracement, that old low point. Not as strong a resistance as the support that you see here. A lot of support in this area, a lot of volume, long-term moving averages, 200-day moving average, these Fibonacci retracements on the long term. Lots of things holding us up on the low end. But there's also some things holding us down on the short end of things. And so it's not going to be quite that easy to break on through. Though you do have, rising MACD, rising stochastics up above its moving average, MACD above its moving average, close to crossing above its own midpoint, which means that 8 days close to crossing above the 17. Again, that's kind of the next layer. Getting above these two averages is one step. Getting that 8-day to cross is kind of the next step, and then getting both lines across the 30 is that kind of final step of a divergence to the upside. That again can last a month to 3 months, probably longer towards the 2 to 3 month end of things because of how low market sentiment is right now. When you look at today's intraday chart, you can see, higher high, higher low, low of the day early, even after a gap, high of the day late, relatively late, and we pull back, back below the previous day's high, back below the previous week's high point. If you notice here, that 4-week high has been moving down. We moved it down again today to the point now where we are in the upper half of the chart. So there is now another bullish bias to this from a technical perspective. You can see, again, now tomorrow we're going to move it down one more, just a smidgen, but after a couple of days, we're going to move it down to this high point on this day, which will be about where we're at. So just in a few days, we will be trading just about at the 4-week high point, which again flips the script from being as bearish as we were to now being, relatively bullish. With a relatively wide range that we can start to continue to push up. And you can see the low point, the more bullish you are, the more that low point is over here of the 4-week range, and the high point's over here. Because again, that means you're pushing it up every day and you're pulling it up on the left. And again, the more that that the high is over here and the low is over here, the more bearish you are. And that's the way we were, but that's not the case anymore, right? So the high is coming off, and the low is migrating this direction. As that low continues to migrate, the more bullish that's going to mean, the more bullish we are. And eventually this is going to migrate down to, like I said, to the point where we're going to be right at it. And we're going to be pushing up against it here pretty darn soon, just by the end of this week, barring, you know, a bigger pullback down below, you know, last week's low points. When you take a look at the daily range here, give it a second to load up, you can see why we're struggling to get through this resistance. You know, the range was just over 2 points. The volume was at 62.5 million. So put that in context here, not SPX, SPY. Put that in the context here, and you can see 2 points is way low. And of course that's bullish, but it's not bullish enough to break through a resistance, multiple resistance areas, and that's why we're struggling. And then the volume is really low too, which again is bullish because that will bring both these lines down. And it's bullish when these lines drop from these peaks, but again, you need at least you need kind of in the middle of this 52-week range to get us through that resistance. And so today we got neither, and that's why we're stuck. That's why we're stuck in this area. You know, you take a look at the volatility index, it's been grinding lower, so it's been grinding below 17.5. And again, because we're so low and it continues to grind lower, that's why I wouldn't be surprised if this resistance holds in the short term and we bounce off of it a little bit, not to, you know, to a new bearish trend, but a little bit from a near-term basis. And then the next near-term bounce will be the one that gives us enough oomph to bust through this resistance and come down. So you might get a bounce in the VIX closer to 20 before we finally can break through and feel solidly bullish here. Here's that VIX on a relative basis. See how it's not in the bullish area yet. It's not in that below the 90% level. It's stuck in the neutral area between 90 and 95%. It's when it gets below 90 that, okay, now we're bullish. Now we're breaking through. Now we can expect a 2 to 3 month intermediate run because, again, of how low market sentiment is. From an economic indicator, we actually had quite a few economic indicators come out. You can see the number for the Empire State Manufacturing is down again. And you can see that usually has a negative impact on the Philly Fed according to that relationship there. You also had retail sales come out, and that's a much bigger deal, but it was a strong number on a month-over-month basis that kept the year-over-year growth rate really high. Good sign from that perspective. Inventories, the sales data has been pulling down, which is a decent sign when the inventories is low. And starts to pull, once it starts to rally, though, that means we're not selling as much, but we are producing more because inventories are low relative to the sales that's able to support those inventories. And finally, the housing manufacturer down a little bit, but still relatively high levels compared to the past. Now, that's had an impact on the economic supplies index, bringing it down to now 21.8, but still, relatively speaking to globally, still a very strong number, and again, very strong number relative to last couple of years since we ran out of QE. The odds of a rate hike still high in June, so economic expectations, I mean, they're down a little bit, but they're still about 95%. So grain of salt with that little pullback. You can see too the odds of getting that second hike. So here, one hike could be in June, and then the second hike by September. We're looking at pretty decent odds for that second hike to occur in September. Then you see that get the third hike in December, 1, 2, 3, and you can see now that pretty decent odds. That we're going to be 3 or less, and you can see to get that third rate hike, we're looking at 33% odds. That we're going to get that down a little bit, but still, starting to move up, and you can see, and again, that's the key month, right? Because that's the third one. That's the one the market's going to be looking for. There's number 2, and this would be number 3, and see how it spiked up from what it was, and the odds of only having one more the rest of the year are the ones that really dropped down. So it's either going to be 2 or 3 by the end of December. GDP estimates were revised today with the data that's coming out. And you can see we pulled down here from the retail sales, pulled down to 1.9%. Low number, but still pretty decently strong number for the seasonal for this quarter, which has been very weak, has been negative, and has been barely above zero in previous quarters. So we're still looking at a relatively strong quarter for the first quarter. This is kind of show you here. I mean, 1.25% was last year's. 0.5% was the year before that. We did have a strong quarter there with a big bump in inventories and a retail trade figure that actually boosted GDP, which instead of bringing it down like it normally does, which is very temporary, and that's why it was so strong. And you can see the first quarter in 2014 was actually negative. So, first quarters tend not to be very strong. So getting a 2% growth rate that's largely driven by these retail personal consumption, very, very positive sign relative to other first quarters in recent years. When you take a look at the different asset classes, this was a U.S. stock market rally today. It rallied. The rest of the stock markets didn't. Emerging markets barely were above zero. Developed markets were flat too. So they lagged behind. In fact, they almost lost out to the U.S. high yield bond market. You can see long-term bonds started the day down, which means yields are up. They rallied by the end of the day, though, finished with a small gain. And of course, crude oil coming down, just giving up some of its gains. So you can see, what was driving is pulling back a little bit over the last couple of weeks. Stock market, U.S. stocks kind of pushing up, but running up against resistance. And because, another sign here that we might pull back in the short term because they are the outperformers in the short term. They might pull back before they bounce back up again and break through that resistance. You see the pullback in crude oil didn't impact stocks, energy stocks. They still rallied up 1% as the broad market was up. And you can see utilities were up 1.4%. Staples were up 1.1%. Materials and energy were strong with a little weakness in the dollar. Of course, financials, technology, this discretionary, these old momentum players are lagging behind. So again, another sign that this bounce is just not that bullish right now. We're coming up off of this low point here, heading into resistance off of that low, and you can see technology, energy's been very strong. Materials is up there. Technology's been strong with healthcare. Everything in these other sectors are weak. They had a good. In fact, you can see utilities and staples were the weakest off of this bounce. They're bouncing up now. So, you want these areas that have been leading us off the bounce to break us through the resistance. And that's not what happened today. So, again, we might get a little bit of a pullback. These areas that have been underperforming might outperform temporarily before these old leadership, which is what you want. You want technology discretionary leading us through. It may take some key players' earnings reports in those areas to get the volume, to get the movement, to give you the catalyst to break through that resistance where there's going to be a lot of buyers and sellers hiding out. So you need buyers to overwhelm all the sellers. Breaking through resistance doesn't mean that nobody's selling. There's still a lot of buying and selling going on. The buyers just overwhelm the sellers. And that's what breaks you through. And then the sellers leave, and that's why volume drops back off again while you're breaking through that side. And you might run out of buyers too because you needed so many to push through resistance, and that's a lot of times why you get the return moves, the pullbacks back to the old resistance, which is now new support. So that those are the areas that you would want to bring in those volume. You're not going to want utilities and staples to bust you through this resistance area. So as long as they outperform like today, then the more likely we are going to get more of a short-term bounce, because they're the ones that have been lagging behind on this current bounce, right? And so people are just looking for, they're looking for some value opportunities there. That's not going to break you through resistance when people are looking through, you break through resistance with the momentum, trades, not with the value trades. So we're heading into earnings season, and for our trade idea of the day, a lot of big companies, Netflix have their earnings tonight. You can see if I pull up Netflix, and we'll come back to this stock for earnings coming out tomorrow night. But you can see Netflix up to 323, so a big move up towards resistance area coming off of 307. With its earnings today, it had a decent volume just coming into the earnings. So decent move. We'll see how it follows through on that. tomorrow. The stock I had up here is a stock that's coming, has earnings coming out tomorrow night. It also has pretty decently priced options. You can see that its options here for this week have 20% higher implied volatility than what you see just in May. The May options, of course, they're a little bit higher, a couple percentage points higher than what you see in June, and that's when they kind of get back to their normal levels there. So we can take advantage, and we know, the one thing we know coming out of earnings is that the volatility will go down, and they kind of show you the impact that that will have on the pricing here just from time passing. So look at the Theo price here on some of these options, and you can see just from time passing, a couple of days, so through tomorrow, through 417 to the beginning of 418, because the earnings comes out after the market, and just that volatility down 20 points to get down to those back end volatility levels. Again, look at the Theo price, just a couple of days passing, what it does, and then you drop that volatility down. So those are two things that we know are going to happen. Now they might drop down more, but these back months might drop down too. But we know that typically that volatility in the front will be lower by expiration than what you see behind it. And so that's, we do know that's going to happen. Now, the stock might move down, and if the stock moves way down past 64.5, then it might gain intrinsic value. See, that's all extrinsic value because it's out of the money. If the stock drops below 64.5, now it will start gaining intrinsic value. So you can see, for me, I know I'm going to make 63 cents. If 68 is, I'm going to make 58 cents. So okay, it can't pass 58 cents on the other side before I hit break even, right? Break even on that level, and the odds of that are lower because that's the options are priced right now for about $1.58, $1.82 plus $1.60, about 3.5 point move. That's what the options are priced. If you add up the calls and the puts here at the money price, right now they're priced for about a $3 to $3.50 move. So you're looking for about a move down to 64. So that you can see that's about where that break-even level would be. And if it stays anywhere in the middle, then you get to make, if it stays above 64.5, you get to make all that 58 cents from what you know is going to happen. So you can say, okay, well, if it can go down to the downside, what if we also did that move to the upside? So let's do the 65 because it has a back month option. We need to buy protection, and you'll see that in a second. We'll sell the 72, so we'll sell both of these for $1.50, but then we'll protect any crazy moves with a long put to the downside and a long call to the upside. So if it takes off one way or the other, then we know we won't lose more than what we're paying for these two calendar spreads. These are both calendar spreads. So again, we know, the one thing we know is, with time passing and volatility dropping to those back month levels, that the 65, there'll be 65 cents made there from the current price down to the theoretical. And then we also know this one here will drop from the mark here at 67 cents. It will drop down to 8. So we know that you're going to make that. The question is how much intrinsic value. And again, now that I have, I have 60 cents there, and I have about 65 cents there. So I got $1.25 now, on outside of the 60 and the 75, and that's where my break evens are before I start losing money. You can see that's what it looks like here. And if I were to say, okay, 1 standard deviation away, there's the 1 standard deviation move in the shaded area. There's my break even. So as long, if I were to, again, to come to here, this reset or change the parameters here, change the date to another day, pass that earnings, change the volatility in the front to drop down to catch up to the back month, then as long as we stay in that 1 standard deviation move at current volatility levels, those high volatility levels there, you can see I have decent odds of success of making money. A pretty decent chance of making money. And then of course you look at the charts, put those break evens on the charts. So there's my 1 standard deviation move. You can see how that's inside my break even levels. Of course, it can make it bigger than 1 standard deviation move, as we've seen before on earnings. But if it doesn't, if it stays right in that area, then I make money. I make money inside these blue lines, which also happen to be lined up with the old high here and the old low point there. All right, so that wraps us up for today. Thank you very much, as always, for watching. Remember to comment or ask questions. Comment on the blog post down below, or on anything that you learned or you got out of the video today. So that way people, when they come to the blog post, they can see, okay, well, I should watch this video because this is what people are getting out of it. And then, like, if you have questions or you want to respond to other people's questions or comments on the video, then go to the forum with that link that's right above the embedded video. And remember, the more you post in the forum, the more likely you are to win one of those Amazon gift cards. So thank you very much again. Have a great evening, everybody. Brandon will be back on tomorrow. We got a full slate of classes going on the calendar here this week. So make sure you're up to date on those classes. That being said, we'll see everybody next time. Goodbye, everybody.